All right. Welcome to Game Plan Sunday. Today is December 22nd. It's our last Game Plan Sunday of the year, 2019. It's been dynamite. If you haven't been participating in this market, I feel sorry for you. There's lots of money that has been made. And so what we'll do is we'll go through our game plan session, and then we'll take a look, get an outlook here of 2020. And then we'll bring the session to a close and let you guys get ready for the holidays here. So anyhow, last week, you already know what the word was on the streets, right? It was impeachment. So impeachment talks all over the news. That's what it was last week. Now, the interesting thing is that although the impeachment talks is on the news, the Wall Street just, gave middle fingers to everybody and said, hey, boom, hit new highs. And so we did hit new highs across all major indices here. The NASDAQ was killing it. The S&P 500 killing it. The Russell and the Dow, industrials actually. So, but the transport and the Dow is actually a little lagger here. So we're seeing weakness there. Everything else is pretty strong. You see, we hit those new prints here on the screen, 32.29 on the S&P 500. So, excuse me. So yeah, that's what it was all about. Impeachment talks, and it's really just showing you how Wall Street is supporting a Trump presidency 2020. As I was telling you guys, every time here that's what Wall Street is expecting. So we did get that. This week coming up is going to be pretty light because the markets are going to be closed starting Tuesday. We get a short day on Tuesday. So Monday is going to be pretty light. I think we got some housing data coming out. Tuesday, markets are going to be closing at 1 p.m. for the holidays. Then, we'll resume back on Thursday. So Wednesday is closed, of course. And that's pretty much it. And then you got 2 more days next week or the following week. And then we bring in the New Year's. But this week is going to be pretty light. Doesn't mean that the markets are going to be pretty light. But normally you get most of the big boys is out on vacation for the holidays, right? And so that's interesting. And then you also have, investors that's looking to either sell off for the tax year or either hold on to their stocks, their investments into 2020 for tax benefit, so they can actually get them on the next year. And so that's probably pretty much what I'm kind of expecting is that the rally may hold. I really don't know. It's interesting. We're at super overbought territory right now. So the overbought territory, the greed that's in the marketplace is crazy right now. In fact, I'll see if I can pull up this indicator here for you guys to take a look at from the fear and greed indicator. We'll take a look at that real quick. I just want you guys to see this, and I'll drop a link for you in the queue, just in case you want to check that out. Save it in your browser. That's of value to you guys. Even on the Facebook side, I get that to you as well. All right. All right, cool. So if you're looking at the fear and greed index, okay, I've been telling you that we've been overbought. Who's freaking buying at these highs is really, really crazy. This is a CNN money indicator here. And you guys can see it. I mean, fear, greed, right? But it's extreme fear and extreme greed. Where are we at right now, right? We're at extreme greed levels, okay? It's telling you right here, now is extreme greed. It's a 91. Whenever you get extreme greed, the markets sells off because, again, the prices are they're overpriced. The stocks, everything is overpriced. Don't nobody want to buy at these highs. Well, I wouldn't buy at these highs, I'll tell you that. But that's what we're looking at. So we have this level of greed that's in the market. This is that Christmas rally, okay? Everything has led us to here. And remember, months ago, Trump was saying how he wanted to have a good Christmas for everybody. That's already been baked in. I want everybody to have a good Christmas so that everybody can be in the Christmas spirits. And it's going to be monumental for, a president to say that, oh, man, I gave us this great market and, all this other extra good stuff for the year. Let me actually get this off the screen. Here they go advertising to me. But anyway, I want you guys to take a look at that indicator so you know where we are. we have extreme greed, and normally that's when the anvil drops on your head. All the good news has already filtered through the markets. We got, Feds not making any moves. Feds are continuing to inject money in the economy. That money's got to get moving. Economic data is pretty decent, depending on how you're looking at it. So coming into this week, I actually don't plan on placing on any new trades. I did actually get off into some setups in gold. I don't know if you guys caught that Tesla situation, but that was crazy. But gold, let me just take a look at gold here. So if you guys are getting into the market, just understand that the days are going to be short this week. So anyhow, taking a look at gold futures, look like it's dropping down a tad bit here. Let's see. Oh, no, it's still holding up. So anyhow, I did some spreads off in gold. GLD is the ticker. And, again, just GLD. That's a ticker that you want to play. And did some spreads. So even though gold went sideways last week, I was able to come out with almost 50% return, which is phenomenal, and considering that this ticker here didn't move, stay sideways. And see, that's the beauty about options. You play it right, you can make money even when it's going sideways, right? So that's what those spreads do. And just milked it. The theta decay helped us out tremendously, which was great. Price didn't really go against us. So we had 2 out of 3 combinations that worked for us. Did close out my gold trades. Gold still is in a squeeze here. So the momentum looks like it's starting to try to drop off a little bit, though. So be careful with that. I do like gold long term, though. So let me actually zoom out and show you guys. Let's go on a weekly chart. So we're looking at the weekly here. Let's take this off real quick. Okay, so here we go. So if we take a look at the weekly here, gold is in a pretty good situation as far as a pattern. Anybody know what this pattern is we're looking at? Look on this side here. All right. The pattern speaks out. Very nice. Here we go. All right. So if you take a look at gold, it's got this nice flag, this bull flag play popping off right here on a weekly chart. It is in a squeeze, and we do want to see this momentum shift up to a bounce. Okay, we do want to see that come into place, but we have to see how it plays out. But normally, this is the way that this should play out. Now, this is a weekly chart, so that's more longer term. This is, into 2020. That's what I'm looking at for that. Also, utilities is another good one. And in fact, I'm actually still holding on to my utilities play. So this was one that we talked about last game plan Sunday. Caught that bounce here, coming back up. Looks like utilities is hitting there. You can see the buy triggers are in there. Momentum is shifting in our direction on stochastics here. So I still like utilities. Again, you have to think equities is one side, and then this utilities is a proxy to safety. And so this is a way that you could play if there's any risk that comes into the markets, whatever that may be. Having exposure here is a good place. The charts actually show and prove that to us here. Again, this is a weekly chart here, and I'm up in this trade as well. I just kept it on because I benefit from the time decay, and that's the reason why I kept it on. I did take the gold off. So the gold trade, I captured profits. Where's Ron at? Okay, so yeah, Ron I was like, yo, what should I do? Should I actually go ahead and take profits now? That was just a test to see if you guys are paying attention, right? Who's paying attention? All right. And Ron just reminded me with the new Wallstreet Jackboyz shirt. It was like, do what your shirt say. It was like, no brainer. Do what you tell everybody else to do. Take profits often, B. So that's what we had to go do. That's what the shirts say. All right. So cool. This right here, straight on our website. You can get the new shirts right there. Take profits often. You see, got the shirts, got the hoodies. Got the sweater. Now I'm gonna tell you right now, this sweater right here, I think I need this money green sweater right here. I think I need that money green sweater. That money, I don't have nothing green. Well, actually, that's a lie. I do have something green. I just don't wear it often. But I got to add this money green into my collection. I don't know how y'all feel about it, but I got to rock that money green. So anyway, that is going to be on the books. Go ahead and put that order in this week. So make sure y'all get that. Had to get the purple for Mia, because Mia, she be blanking on me if I don't get the purple. So anyhow, make sure y'all get the new shirts. And I'll drop that link in here for you too, so you guys can check it out. But the money green, I think I got to get that money green. That money green looking clean, man. I'm telling you. Ron, you like the money green? Ron said he like the money green. So I'm feeling that. You guys that's in the holiday spirits, go ahead and get your shirts, your sweaters, hoodies, what have you. Those are there. Anyhow, so what else we got popping off? Gold, utilities. If you are looking for some setups this week, there's a little bit setups that I was able to capture here. There's a setup here in LuluLemon. That's in the clothing sector. Okay. So anyhow, it's got a buy trigger on this one here. We have a bullish chart and we got a buy trigger on Lulu. Okay. It's Christmas time, people shopping. Okay. Everything seems to fit the narrative here. We did catch this pullback right here at the floor. Got a buy trigger here. We'd like to see that go up to about 10 points at least. Take those profits off when you hit that target. So that's how you want to play that. If it does not go toward that target, if it comes down to this floor, you cut the trade loose, take your loss. That's how you play that. All right. What else? We have, well, let's see. If you look at my scanner over here to the side, you can see Decker's Outdoor. This may be coming up into a setup. It's got a squeeze on it. The buy trigger that was in there, little 1 dot squeeze popping off. The trend is starting to move with it. Clearly moving above all moving averages. Bullish chart. Like to play that to the upside, or at least see it to the upside if you're going to play that. And then one last one. Paycom. Paycom is actually looking a little interesting here. Did get a sell trigger here, but that sell trigger kind of came out. So it didn't. It kind of just went down here just a little bit right there. And looks like the shorts are coming out. You're looking at the stochastics fast time frame. They're shifting upwards. And so just pay attention to the 618 retracement. That's 270. I mean, you can actually play that all the way to 270 and take out. If it plays all the way to the long side, then you're looking at about $287, $290 target. So that's what you're looking at. Oh yeah, that's right, Chance. You can get your gear, man. Get your gear. Get the Wallstreet Jackboyz gear. We got it. We rock it. All right. So that's what I can see on the horizon right now. The market is a little tricky right now. Again, as I showed you guys earlier, the fear indicator, the greed and fear indicator, we're seeing excessive amounts of greed. Everybody's really taking advantage, throwing money at this thing. And the markets have rallied into overbought territories. And so quite naturally, it needs to come back down. Let's just pull that back up. So quite naturally, this here needs to come back down. Let me just give you. Okay. So if you guys looking at my Ready Aim Fire, these are the boundaries. Okay. We do have an aim tool that's showing up here. It says aim. So it goes ready, aim, fire. That's the way this thing right here goes. All right. So when we see that, we caught a fire here. It had a nice pullback. Anticipating a fire up here this week to a pullback, at least to the 8 or 9 moving average. This thing really needs to come down to at least the 50 though. Will that happen tomorrow? Possibly not. Just depends. But I think that the market's it definitely needs to consolidate, if anything. And so even going into 2020, these evaluations here are extremely high, which we'll take a look here once we do the outlook, and I'll go over some of the stuff here with you guys. But basically, the earnings of these companies, these corporations, it's not actually justifying what we're seeing in the stocks. Again, all right. I don't know why I can't see the feed here on this side. I'm trying. Oh, you know what? Because I got to keep up with it. There we go. All right. So basically, because that's in the play, tread softly. What I recommend for you guys this week here and next week, because we're going into 2020, is to basically evaluate your trades. Okay, this is a good time to take a look at how you did over the past year. If you don't have the Wall Street Jackboyz trading journal, then definitely get it because it is phenomenal. I don't know anybody else that has anything like the Wall Street Jackboyz trading journal. And I put it together for a good reason. That reason is so that you can learn about yourself, because trading is about self-mastery at the end of the day. We got blueprints, we got guidelines, but at the end of the day, you got to find what works for you. That trading plan is going to help you to find out what's working for you. And so take this week off. That's what I plan on doing. I'm going to exit these trades that I got. I'm going flat this week, just so you know. And to assess, how did I do over this week, over this year? Because it's been a very interesting year. We have lots of different things that happen. And how was I able to manage and navigate through the markets throughout all, everything that we know? There's a lot to happen. And so what you want to actually do is learn about yourself. Learn what worked for you during certain times of the markets, when the markets were choppy, what was working and what wasn't working. When the markets was popping, what was working, what was not working. When the markets was, wreaking havoc, all those different things. Go in and see what worked for you, and you'll be able to easily see those things with the trading journal, of course. So definitely get that if you don't have it. I do have a new one that we're actually coming out with. So if you get the trading journal, any updates that we do, you get those for free. And so, Mark, Mia, they already got their hands on it right now, just so you know it's working. It's working. So got that coming. But I want you guys to actually learn learn about yourself. And so going into 2020, you're going to use that information to help shape your trading plan. Okay. So I put together my trading plan for this year. I shared it with you guys, and that gives you some framework. So you'll know, hey, these are my set of rules. This is what I'm expecting. All of this, that, and the third. Get you the trading journal. It's definitely very, very helpful. And so we got some nice enhancements on that as well. So that's why I encourage you guys to take a look at this week. Other than that, I don't know if you guys have anything you want to take a look at right now, but I can take some questions from you. But I would like to actually get into a little bit of, just digesting what happened in 2019, right? So we just digesting what happened in 2019. There's a lot of things that happened. Okay. For one, we're in the longest bull market in the history of our nation, basically. So the longest bull market in history here. And how did we get here, right? How did we get here? So we have two things. We have fiscal policy, and then we have monetary policy. Fiscal, anybody know what fiscal policy is? Fiscal policy. Anybody know what monetary policy is? Okay. So we got fiscal policy, we got monetary policy. All right. Fiscal policy, central government. Okay. Monetary, central bank. That's the feds. No chance to scan any charts. Same here, Ron. Let's see, Dustin learned the hard way last year at record highs to sit back and let things play out. That's right. Yeah, Dustin. Yeah, this is a good time to just observe, watch the crazy, irrational monies do what they need to do. But I don't want to get in at these highs. You guys can see that little mark right there. You see how high we are? What goes up must come down. All right. So anyhow, fiscal policy, monetary policy. So what played out over the course of this past year that got us to where we are right now with all these great highs is you had, residuals from the tax cuts that, from Donald Trump. That's fiscal policy. Okay. So that has a direct impact on the markets, businesses, for people spending money. Monetary policy, the Feds went from QT all the way to QE. All right. QT is quantitative tightening. That means they raised up the rates. That's how we had that blip in 2018, that crash, basically. And then the markets rallied up ever since because the Feds decided they were not going to do anything. And then they straight up went to cutting rates. All right. So we have a couple of rate cuts this year. And all of that's feeding into the markets right now. All right. So that's pretty much what helped us get here. Along with that, now we did have the repo crash. I don't know if you guys remember about the repo markets. It's basically banks. They borrow money from, smaller banks borrow money from other banks. They have these, these treasuries and replace for it. And anyhow, they're supposed to buy these things back so they can get money. But the banks didn't have enough money to lend out. So we have these things called liquidity shocks. So the banks ran out of money to make it simple, banks ran out of money. Feds jumped into the markets and started to pump money in the system. And they've been doing that for quite a couple of months now, actually. And they're planning on continuing to do that until February. So the Feds is, putting it in there. And so that would give the markets, reason to be at these highs and to continue to trend, to drift off. Basically, it's drifting now. That money is still pumping in, and the Feds is actually, providing full support for the markets. Now, typically when the markets do that, when the Feds jump into the markets, that is not a sign of a healthy economy. That means something is wrong or something is weak, and they're trying to save it, right? They're trying to save it, and they use their policy, monetary policy, right? So they cut interest rates, and then they actually do what's called quantitative easing, where they're actually buying assets, right? So they have QE4. This is what they call this one here. I don't think they've actually called it that yet, but that's actually what they're doing. They don't want to call it QE4 because of word psychology. Investors start to panic and start to save money because they're anticipating the recession to come. So they're trying to avoid to use the word psychology, but that's what it is. Feds is juicing this all up. Let me actually pull up my information that I keep track of. Okay, here we go. All right. Let me just zoom in on this a tad bit. I know these charts are a little small. I'll zoom in just a tad bit so you guys can actually see these charts a little better. All right, cool. So just taking a look here at the year. Again, this is just an assessment of the year. GDP, tanking down here. It's slowing. Okay, I said tanking, but the real term should be slowing. So growth is slowing. Okay, we are seeing that at 2.0. The forecast for next year is that it should be somewhere around the same. It should stabilize around 2 to 2.3 for the year. These are what the major economists are expecting for the growth to continue to trend about this area. So you may get a bounce up into like this zone here. That's pretty much what all the major economists are projecting for the growth to continue. Now, inflation here, again, I track the PCE, and then you have the CPI that the Feds they track, but the PCE is, I think, is arguably the better indicator here. But with the Feds, they have this goal of 2% that they want to get this inflation at. Inflation has basically been dead and just basically not working. So you hear President Trump, is saying, hey, keep on cutting those rates so we can get the inflation. Inflation ain't even nowhere, near your goal, your target. Give me that cheap money so I can grow this economy. That's what he's asking for. Fed has this 2% target. We did hit there, but they wanted to hit there and sustain there. And so Fed Powell was basically saying that even if we hit 2%, they're still not going to raise interest rates. Raising interest rates will send this whole thing straight to hell. They're still not going to raise it. They need to see it hit 2% and sustain. With all the money being thrown into the markets, we got all the deficit spending right now. I'm pretty confident that we're going to see inflation raise. That's why the Feds are doing what they're doing. Now they cut interest rates all the way up until December, this month basically, which the markets was anticipating because we only got 1.5% basically left that they can actually use. So we'll cover that as well. But anyhow, going into 2020, I do expect the inflation rates to get, up to the 2%, if not surpass it. And so I do expect that to happen. The Feds, again, they're not going to cut rates. So they're not going to raise rates. That's what they are saying, that they're not going to do that to support the markets. Now, if they change their mind, you already know the markets is going to sell like hell. So that's a particular risk for the stocks to go down, that'll send them, spiraling down the same way it did last year in December. So we got to keep a look on that as well. Chance, do you do M&A trading? No, I do not. You're just trading options, buddy. Stocks and options. All right. So the U.S. Treasury yield curve, that's one thing that we had this year as well. We had the yield curve to invert, yield curve inversion. When the yield curve inverts, a recession follows afterwards. So the yield curve is a leading indicator. It's, telling you, hey, this is what's coming down the pipeline. The only thing about it is that we don't know the timing of it. We just know that it's just giving us heads up that this recession is going to come. So we did get the yield curve inversion here on this particular chart. And maybe I'll pull it up later. But on this particular chart here, you can see the yields from last year, which I charted from that level to that level. You just see that they came down. So these are the bond yields. And this is where we are right now. As you see, the Feds, they're controlling this part here. And they're keeping it here at this level, 1.5. So this is how much interest rates we have from the Feds to stop a recession. Now, normally they need 5%. They don't have it to give. And so I think part of the play is that they're going to hold on to this 1.5 as long as they can. OK, and when things continue to deteriorate, then they can actually at least, cut us some more rates going into the end of 2020. OK, I did see some forecasts from Wells Fargo. They're actually projecting another rate cut at the second quarter, I want to say, or the end of first quarter. They're expecting the Feds to cut rates again to 1.25 next year. Other forecasts has, 1 or 2 rate cuts of next year. So the Feds pretty much we're projecting that they're not going to do anything. And it's probably going to be until like the end of the year. It just depends. So that's more monetary policy. Right now, they just got it on standby. They're supposed to be waiting. And keep in mind, although they're pausing on the interest rates, they're still injecting the liquidity in the financial markets until February. That's what they want to wait until February to see, is it working? And basically from there, we'll find out if they're going to continue to inject money into the markets. So that's something to look out for as well. All right. Wage growth has pretty much been, stagnant, sideways when we factor in, all of that. These moves are parallel to each other, basically. Those are slightly upwards. All right. And I don't know if you guys saw this or not, but, Trump and them just passed the spending bill, deficit bill, basically. And it's a lot of spending in that bill. A part of that is federal employees and military employees, for you vets out there, just got a raise, 3.1% raise. Now, that's pretty phenomenal for you federal employees. So that also may help this wage growth because, again, I mean, that's, from the federal government, they're going to raise their rates, their income by 3.1%, which is interesting because then when you take that in consideration, that means that they'll have more money to spend. When people get more money, they normally spend the money. They normally don't save it or invest it. So they normally just spend it. So they're getting a raise. We may see a little more spending. And remember, this economy is based off of the confidence of consumers. And so they're doing everything they can to keep the consumer confidence, in part. And so far, so good. The spirits still seem high for Christmas when people are spending money. And then you got to think first of the year, you also have, income tax refunds. And so that may be enough to keep, this thing going. Because consumers get their hands on more money, a February time frame, I guess. So then they'll be back spending more money. And that should carry us into, into the fourth quarter. is what I am projecting. I don't know what everybody else is seeing, but the way I'm playing it out is kind of like a movie, right? And so we have Feds injecting liquidity. We got tax returns that's coming. We got the federal spending, budget spending that's also going to help out with those federal, jobs. We got some temporary jobs that's in there. But I think that one of the biggest things to take a look at for next year will be the jobs. Definitely want to keep our eyes on this. Employment rates, again, these are at historic lows. I really don't think we can get no lower than this. Maybe we can. That would be interesting. We already hit these historic lows, but I expect to see these things to bounce. And the reason why is because here with the PMI numbers, we are at recession levels. Anything under the red lines means that contraction is here in the manufacturing. And as we can see, those are under that 50% threshold. And what this is telling us is that companies, they're losing their confidence in investing and also buying raw goods to make materials, because either demand is slowing, which they have been talking about. Demand is actually slowing, and that's the economic force there. So demand is slowing, so that means that they're not actually selling as much. So if they're not selling as much, they're not going to order as much. And from the yield curve inversion and everything else is kind of pretty much the economic data hasn't been strong by not at all, really. We've seen the GDP slowing. We see yield curve invert. Now you did have these unemployment that was looking really good, but I think that we're bottoming out. Now I may be wrong, but it'd be interesting to see this. If this turns up, that's not going to be a good sign for the economy. Jobs growth, they've revised these things. Lots of manipulation in these numbers, but overall, jobs has been actually pretty good. So I'll give credit when it's due in the data. But it is a lot of manipulation, a lot of temporary jobs, a lot of people working multiple jobs, job holders, older population, people that's working jobs, people that's stepping out of retirement, having to go back into the workforce. These are just numbers. So the numbers are not just, on the surface level. A lot of these numbers, you have to think about them, from like a plane to, spherical. They have all these different levels to it. So anyhow, so anybody can, argue these numbers here, you can't take them for surface value. We did get a lot of store closings, a lot more this year than we did last year. So the green line is where we were last year. Ended 2018 with that mini loss. This year, this is where we are up here. I haven't updated for these past weeks, but we're probably somewhere about here. So, close to 10,000 stores closed. Okay. And we did actually open, a little more than we did last year. So that's, a little bit positive, but, it's such a small thing. This right here wipes away all of that. Look how big that is. So you are seeing weakening in the store space, retail sectors and stuff like that. What else? Home data looks pretty good. This data here is all looking pretty good. Let me just give you guys this much. All right. So consumer debt, debt levels are, pretty high. This is from those last highs there. You can see all these different colors. Hopefully, they don't hurt your eyes. But we have exceeded the 2008, debt levels basically. So we are seeing spending, but where's the spending coming from? The spending is coming from debt. So a lot of people are taking out loans or debts or loans from their retirement or what have you to keep the spending. So although the spending is there, you have to also assess where is the spending coming from, right? We have student loan debt that's ridiculous. We have auto loan debt that's also pretty high. Now, they have been able to pretty much contain the mortgage one. I tracked this one as well because you guys can see back here, you can see what led to the crash of '08, right? That's the people with the lower credit scores that were getting approved for those homes. Now, they have actually contained that. If we look to the right side of this spectrum, you can see that everything is properly appropriated. So people with the higher credit scores are the people that's getting the loans, right? And so the credit standards for the housing is good. So, every recession is different though. So you have to think about, 2000 was the dot-com crash, dot-com bubble. And then we had a housing crash. And so this next crash coming up, the next recession coming up, more than likely will be different. I don't see any risk in the mortgage side. I don't think anybody else does either. But corporate debt does speak out to a lot of economists, the IMF in particular. Everybody's talking about those things. So anyhow, that's interesting. We'll keep our eyes on that. This year, the number one performer was the NASDAQ. And that's not by surprise. That's the tech sector. So you guys already know technology is still leading the way. Technology is booming. The S&P 500, again, if you guys, should be at least 25% in your 401ks, somewhere around there. If not, then you need to reallocate your holdings. Okay. And it's a good time to take a look at those things. Okay. So anyhow, transport has lagged, and that's interesting because with transportation lagging, you got FedEx earnings that came out that just FedEx tanked, tremendously. They were negatively impacted by, Amazon, and they have some other things. Their cost point for transporting is expensive. It's too expensive. And so I'm expecting more weakness in this sector, actually, so anyhow, so that's just taking a look at that. What else we got? Sectors. Now, we did like a little poll last year about like which sectors you guys think. Y'all want to do that poll again, where we do a sector outlook? What's going to be the top sectors? You guys want to do that again? Because we can do that. Just basically taking a look at the sector performances here. Technology again. You see the breakdown. Technology at 38%. Return if you were in the tech sector, which is XLK. And then consumer, let me see what else we had. We had, industrials actually. So industrials was number 2. So the industrials is number 2. Who's number 3? Real estate. Real estate was number 3. So these were the best performers of 2019. All right. Number 1, number 2, and number 3. Those are the best performance sectors. Now the worst performance sector. Was energy. This is the worst. Energy. Okay. So energy sucked. What else? Materials sucked. Not really. It didn't really suck. It's all right. Healthcare. That's what it was. Healthcare is what sucked. In healthcare, here we go. So healthcare sucked. And I think that going into 2019, a lot of analysts was projecting that healthcare was going to be taken off, right? And here we go. Healthcare is the second worst performer of the year. So again, we're just speculations here. What sectors do you guys believe will be the best performers of next year, right? You don't have to be a genius to do it. It's just random guessing. It's not going to, take anything away from you. All the experts, again, as I was telling you, all the experts are telling you that healthcare was going to be the best performer because of, the House winning, the Democrats winning the House, and, the Republicans maintaining the Senate, and that they were going to be able to do some bipartisanship stuff, and they was going to be able to work it out. And as you guys can see, it's been a total opposite. They just impeached President Trump. Okay. So anyhow, it's going to be interesting going into this year. So I set up a poll for you guys on that just to hear what you guys think. And then I participate also, right? So we all participate in that on what we believe is going to be good. Okay. And I think that's pretty much it. As far as, let me take a look at the commodities. I haven't updated all of this. Let's see. Commodities. All right. So just taking a look at gold. Gold actually, at the year, 15%. Pretty good. Oil was at 30%. So I think oil is going to be interesting watching this year as well. So I think we got to keep our eyes on oil to see how that plays out. And gold as well. These are two big ones. Now, palladium was killing it, 43%. Don't you wish you had your money in there? Palladium was killing it. All right. Platinum was right there, neck and neck with gold. Silver lagged that, but still right along the same same lines there. So I think that's pretty much all I'll cover here. We got the Forex. I don't know if you guys keep up with that, but we are going to be watching the dollar out of all of these. Little red dotted line that you guys see here, that is the dollar. Actually, this red dotted line is the dollar. I like to measure these other baskets in comparison to the dollar. So these are things that I keep up with. Just keeping track with that. You see the British pound outperforming, Canadian dollar outperforming, the peso, Mexican peso outperforming. So that's, good insight. You guys want to see that. So basically, we want to actually pay attention to the yen and the dollar this year, see how those play out. The yen normally plays counter to the dollar. Okay. But that yen goes up, stocks normally falls down. So that's another way that you can take a look at that. And I mean, it's in a good position to actually kind of go up, but we'll have to see how that plays out. And the dollar is actually starting to come down a little bit. So it's going to be interesting to watch the currencies this year coming in. I think that's pretty much everything that I pretty much had to cover as far as what I'm seeing. One thing also to keep in mind that we want to watch out for this year would be we want to see earnings. All right. I don't have that in my chart here, but we definitely have to keep our eyes on earnings to see how these corporations are doing. Earnings is pretty soft. Coming into this last quarter here, we want to be able to pay attention to that because we want to see, with these asset prices, these stocks being so overpriced, if these companies are not going to be able to bring in that kind of return, I think that's definitely going to have a negative impact on the markets, depending on their earnings. So we got to watch the earnings this year. Okay. We also got to pay attention to the consumer confidence because, again, majority of the economy is from consumer confidence. And so as long as the consumers are confident, happy, and euphoria, things are pretty good. But keep in mind, remember this year when the yield curves inverted, there's a lot of talk about the recession. Okay, recession that's coming, and I even wrote an article about it. Right, when everybody was talking about a recession, it was like the number one Google search term. The markets mysteriously went the opposite way. Did you guys notice that? Everybody. Okay, Dustin, good to see you, my man. Yeah. So when everybody was pointing to one direction that, hey, this is going to happen, the total opposite happened. Lesson learned, right? Because there was too many people that was focused in the same direction, and the markets just flipped the switch the other way. We had the markets that end up drifting up these, to these extreme highs, all the way up to these extreme highs. And there's no fundamentals to really to even back that with weak economic data. The market still rallied up. There's too many people that's actually going in that way. And so right now, too many people are saying that there's no risk to a recession. So I wanted to paint that picture to you so that you can actually see the extremes in the media. I showed you guys the fear and greed indicator for CNN. These are things that we have to watch out for. So last thing I'll show you guys before we bring it to a close is the VIX. Let's just look at the VIX here real quick. So we're looking at the VIX Futures here. Excuse me. All right. So the VIX Futures is actually starting to rise up a little bit. And that's interesting. So this floor down here, you can see how it bounced off that floor. Now it is trading sideways up against the 618 retracement. And so, again, this may chop around a little bit up here, but it's still something to keep in mind. Now, something that's interesting, you can kind of look at that this could be an inverted head and shoulders, right? This could be a shoulder here. This could be a head here, and this could be forming a shoulder, and this thing could take off. So keep that in mind. I actually want to pull up the VIX Index. All right. So when we talk about the greed, when the VIX is asleep, the markets get greedy. VIX is asleep, markets get greedy. So we've seen a lot of greed here The levels we already talked about. That red line is a key level. I'm going to keep our eyes on that because normally the markets respond to that line, that level there. So when it hit that, it normally bounces the opposite direction. Okay. See that? And we get like a violent move to the upside. And so we're here at that level again. And we're seeing that it's going into the oversold territories, right? So it's oversold. It could breach this level. But anywhere, down to these levels here, will, to me, will signal a reversion. So to come back up. So the fear indicator is something to watch out for as well. I don't know if we're going to see any volatility this week. I think we're going to probably, the markets is probably going to trade sideways, or maybe even take out another high going into Christmas for the holiday this week and New Year's. Everything ending on a happy note. But the start of 2020, I think I'm expecting some sell-offs for tax reasons, and I think we'll finally get like a nice pullback, a nice healthy pullback. So this may carry us into 2020, and then we get some sell-offs. But right now, just take this time to reassess, what's working for you, what's not working for you. Formulate that trading plan. Get that trading plan. Maximize, to your strengths, and then let loose of your weaknesses, basically. Which again, what strategies are working for you? Whether the long calls are working, or is it the spreads? What's good, man? So I see you, my man. Thanks for logging in. You late to the party, man. You late to the party. And I didn't do anything on the crypto world. I haven't taken any look at that, but I'll definitely take a look at the crypto world because crypto is still very interesting. I believe that crypto is going to have an interesting year as well. For one reason is that China is getting ready to launch their new cryptocurrency. And I think that's really going to, have a major impact in the markets. I believe they're going to be doing it this year. They're buying a lot of gold to back that up. So that's, again, we have a supporting buyer. We got China and Russia that's buying up a lot of gold to back, its cryptocurrency. Again, they're trying to flee from the dollar, right? But it makes things interesting. I think that the trade situation, I don't really think anybody serious investors are, counting on a trade deal to come into fruition before the 2020 election. We got this phase one deal at the end of the year, and it was nothing. It was pretty much a bailout for the farmers. So it's pretty much that. And you still got to see how that's going to play out. So you're basically trying to, provide support for the farmers. Other than that, there's nothing beneficial for you and I or anybody else in the economy with that phase one of the trade deal. So, but Trump, he's a good salesman. So, when he's telling, I like when he's telling, but sometimes he's selling. Again, he's trying to sell himself into the 2020 election. So keep that confidence up, keep people spending and confident. Although, you can't ignore the real data here. So, anyhow, these are particular risks that we have to, pay attention to. I just don't see anything really with the trade deal. Maybe he'll get a part two, a phase two. He may get a phase two, which would be more substantial. If he can get a phase two, that would definitely help him out with his presidency, and also help the economy out more as well. A lot of tough talk, but it was dragging the economy down. You see how December 15th, they did not actually put those taxes on. I did have some hedges on for that in particular because they waited to the last minute. But I knew that he actually wanted to do the deal because he already mentioned that he wanted to have a good Christmas. There's no way you can have a good Christmas by slapping on an additional billions and billions of dollars of tariffs. That would have wreaked havoc on the market. So I already knew he was going to do that. But again, that's a sign of weakness as well. And so to me, it's actually looking like China has the upper hand because of that. So it's going to be interesting to see how this stuff plays out. We already see North Korea starting to deflect. Things were cool about a week ago, about a year ago. And now it looks like North Korea could bring in some unexpected risks. As you guys remember the year before, every time North Korea was talking about launching missiles and this, that, and the third, the markets was, puking. And now they're starting to come back. And so expect that, anything with that could actually negatively impact the markets this year as well. So don't sleep on the North Korea situation. In fact, I think they're doing something this week with China and I think China and Japan They're trying to get them to do the denuclearization, stop their nuclear plans. And that may blow up in their face. Again, that's a particular risk that could show up in the markets this week. I believe that's coming up on like Thursday or something like that. So anyway, those are some key things to look at. We do want to see if the manufacturing, levels are bottoming out. Will they rebound next year? I mean, that could be a positive note. As of right now, they're at recession levels, and so I don't see that. Corporate buybacks, they have record corporate buybacks. So these companies, the tax cuts, the savings they were able to get, they were buying back all their stocks this year. That's why another reason why you see the stocks hitting these crazy highs. But all of that's running out now. So it's going to be interesting coming into this year to see if they can produce earnings, which I don't believe they're going to be able to do. I really can't see it. I see these Chinese companies are killing them. So we'll have to see. As long as people are spending, though, that's good, positive for the markets. Remember, Feds, they're going to keep that 1.5% on standby, just in case things start to weaken. Then they can go ahead and put that monetary policy in there. I think that's why they're trying to hold it to carry Trump into 2020 election. Also, remember, Trump's admin, they are talking about new fiscal policy to get money into the hands of the citizens. And so that's going to be interesting to see how they do that. There may be in another form of a tax cut. They're talking about possibly eliminating student loan debt, which I think that they probably need to do that anyway, because it's really hampering the economy. So anyway, it's going to be interesting to see if they maneuver any fiscal policy, and what that means. What fiscal policy would they use to help keeping it spending? So we got Fed still injecting money. That's still going. I see that we very well may be able to go into 2020 without a recession. And so I think that 2021 is probably a higher probability of a recession. The Feds, their hand is very limited. They only got 1.5% left. And once they exhaust that, Fed policy doesn't work anymore. Negative rates doesn't work. We see in Japan and all these other places it doesn't work. And I don't think they want to go that route. It's really going to hurt the dollar. So again, they only got that 1.5. Once they exhaust that, it's going to be a wrap. So anyway, I think that we probably end, on a positive note going into 2020. And I believe that Trump is going to get the presidency. Wallstreet money is already banking on it. And so once he secures that, then you have to see how a situation with China go. With China try to hold out even further, we'll get a lot more risk coming to the markets after the election. So the election itself is a risk factor as well. So just keep that in mind. Brexit, you had that may have some implications in the markets as they start to, free themselves from the union. So we got lots of risks, and then we got some good things. And so I just want to actually highlight those things for you guys so we know what we're looking for this year. That's what we got in store for this year. What's good? Okay, you mean for the visual to be okay? 2020 would be a year of crypto, and yeah, good info. Okay, thanks, man. So yeah, appreciate you stopping by, man. I think I kidnapped you guys long enough. It's been an hour. But anyway, it's good to catch up with you guys. Talking to Mia, I know Mia was talking about she want to do another Build Your Stacks game session. If you guys really like the Build Your Stacks game session, let's actually do something in the first part of the year. I do have new improvements that we're bringing to deliver, the best quality that we can, which I'm actually working on now. So we got some new course material that's going to be coming. We'll be revamping the website as well. The website is super dope. If you guys haven't been there, make sure you check it out. But I do have some improvements that we're actually working on. And so delivering, high value content, we're going to continue to do that. If you guys are new in here, just check us out at Wallstreet.Jackboyz.com and see what we're about. Join, check out the classes. That's all I think I have for you guys, man. All right. I'll be in the room this week on Facebook. If I see anything, I'll let you guys know. Other than that, take it easy. Spend time with your family, your friends, people that, your loved ones. That's what really matters. It's not about the money. It's about, what can you, what value you can bring to your community, your people, your friends, family, your loved ones. So that's what it's all about, man. So anyhow, you guys have a good one, man. We'll catch up. Okay. Yeah, have a good one. Peace.